all of you have heard of LIBOR, and so there are there's two graphs in this chart. Okay, so the red part here, which is the left scales, it's basically the euro. All right, there's something here. Yeah, is the euro versus the dollar. And the right chart, so everybody is referring to LIBOR, you know, US dollar 3-month LIBOR, you know, for the US, for the Eurozone. And just to say what LIBOR is, London Interbank Offer Rate. Basically, banks make money by holding other banks' money. They lend them money overnight, and basically there's many costs of money. And you know, there is a group of banks in London, and they give basically they put the average of their interest rate for many currencies. This one is called the US dollar LIBOR, and at a certain time, around 11-ish, they basically determine what is the cost they charge for lending US dollars for a period of 3 months. And LIBOR could be 1 month, 3 months, and 6 months. So we do 3 months, okay? So basically, as I'm sure you've known, and now I'm sure you've known what happened yesterday. What happened yesterday when the global central banks intervened, and they had that liquidity drive, the reason that drove the Dow 500 points, the reason that drove everything up against the dollar and everything else up against the yen, was that, and the commodities, was that basically the central banks of the world, they came in and they basically, and the Federal Reserve came in, and the Fed said, I am going to provide, I'm going to engage in a swap of currencies where I'm going to give the Federal Reserve of the United States, I'm going to give US dollars, and I'm going to take euros from the Central Bank of Europe, from yen from the BOJ, Canadian dollar from the BOC, the sterling from the BOE, and Swiss franc from the Swiss National Bank. Why is that? Because basically the European banks, when they had the liquidity shortage, they wanted to raise money, and basically they wanted to demand US dollars. It was very hard for them to raise them because no European banks wanted to lend to the other ones, so they go to the mother of the US currency, which is called the US Central Bank. What is different from the September 15th operation, if you remember, we said it to our clients and everything, that it was in September 15th, almost a few days after, before the 3-year anniversary to Lehman, where basically they came in and they intervened. The central banks came in, and the U.S. Federal Reserve led to, they basically gave in, they did these currency swaps, and they provided dollar at a cheaper rate. The difference between then and this time was that this time not only the Federal Reserve came in and they took yen from the Japanese, and they took currency from everyone, and they gave them dollars, but this time the Federal Reserve actually reduced the cost of dollar, basically the swap cost of US dollars, and they reduced it from 100 basis points over the regular cost of doing it to 50 basis points. So basically they lowered it. Now the other thing that we added to the commentary and everything else, a lot of people have been saying, oh my God, you know, there was a French bank was about to go under, that's why they did it. That's probably the fact, but a lot of people, they did not say the following. What happened is that September 15th, the Federal Reserve came in and they engaged in 3 loan facilities, and 2 of these are set to expire in December 7th, meaning next week. So basically, as these are expired, so when they expire by next week, there's going to be a liquidity vacuum. And if the situation with Europe worsens, that security vacuums become even worse. So the Federal Reserve came in and they took the relay and they've tried to fill the void by adding more facilities. So come December 7th or the 6th, which is the maturity of those liquidity facilities that were created in September 15th. Okay, basically they won't be any void, and they did that. So that's very important. What does that mean in English? What does that mean in English? Does that mean they're going to do these things again? Of course. They've done this like around, I think, 3 times already this year. They're going to do it again probably in February. So in February, expect to see another pop. Now let's go back to this. So this LIBOR here, ladies and gentlemen, this is the green one or the white one, is the difference between the Euro LIBOR minus the US LIBOR. So Euro LIBOR is higher than US LIBOR for various reasons. But the Euro minus the US LIBOR, it gives you a number. That number is the spread, which is this line here. That number, as it goes up, the euro goes up, meaning that when the euro LIBOR is more than the US LIBOR, meaning when the US LIBOR is cheap, that is to mean nobody wants it and nobody asks for it, when the sun is shining and the sky is blue and the birds are singing and everything is fine, the Europeans are not panicking and they don't want dollars, so the cost of dollars doesn't go up. So the euro LIBOR cost is still well above that of the US. Things bad, demand for dollars go up, the LIBOR goes up, and the difference from the euro goes down. So what does that mean? So basically what we're seeing is that over the last few months, when we basically had the US LIBOR going up, that means the spread of euro minus US going down, and as this goes down, the euro dollar goes down. So basically it took me around 12 minutes to explain that why is there the positive correlation between the euro dollar and this spread. And the reason I look at it, because look, when I wrote this article, it was a 0.96, okay, meaning the euro LIBOR, the LIBOR spread was 96, right? And when it was 96, ladies and gentlemen, the price was around 136. Right now, okay. Right now, the spread, so in here I said when I wrote this article a few weeks ago, it was 0.96. Right now it is less, okay? It's actually below 90. So what I'm going to do, I'm going to go here. It is 0.87, okay? So if I'm going to chart this, this is how it looks, okay, guys? This is how it looks, okay? Look, this is the spread. So basically, you know what has happened. When it collapsed here, it was, what does it say underneath? What does it say underneath? It says September 08. Okay, we know what happened September 08. Lehman, AIG, and so on and so forth. It collapsed. All right, and then it went back up. Why did it go up? It went up because it happened in December 08 when the Federal Reserve took interest rates, U.S. interest rates, to practically zero. And then we dropped again. So what we're saying here is that we're saying this is happening. Now let me show you something else. Let me show you something else. Instead of talking, enough talking about these spreads, let's look at the U.S. one. So for those of you who are saying, okay, that means, okay, Ashraf, we got it. How many more minutes is going to take you to make this point? Well, just when you thought, I'm going to move to the next slide, I'm going to hit you with another one. We're on the same point. I'm going to look at the U.S. 3-month LIBOR itself, just to show you. Okay, so basically, here is what we need to see. Basically, so the demand for U.S. dollars is going up by the foreigners, by the European banks. That's usually a sign of bad liquidity. It's been happening since the summer, since July. Look at this. Look at this. Make sure you're sitting. Make sure you're sitting, because if you're standing, you're going to fall in your seat. No, probably no. No, actually, I'll leave that for some other charts. But here's what happened. Basically, the 3-month LIBOR in the U.S. is pushing higher, and this is the highest point since here. What happened here? This was June 2010. Aha! What does June 2010 means? June 2010, that is around, this is when the euro reached the bottom at 118. Okay? Which is basically the same thing as this chart. So euro, so 2010, this is when this thing, the red thing called the euro, okay, this thing called the euro, when it reached the bottom and it hit 118.70, I believe, or was it 117.80, in June 2010, and this is when the spread fell all the way. Why did it reached the bottom? Why? Because the U.S. part of the spread reached a peak. But what does this mean? What does this mean? What does this mean? If a part of this is this, which is this. So what do we say in English, guys? What do we say? That means that we are on the verge of breaking above this this level here in the US dollar LIBOR, and it seems probably by Wednesday's operations of the central bank liquidity, whose main objective was to bring down this thing here, this cost of US dollar LIBOR. So if that happens, and if that happens, if this continues to drop and there is no bad surprises from Italy, because, you know, Italy, they changed the government and everything, but they still have to implement the austerity. They have to still raise the taxes on the rich people. They still have to raise the, agree on raising the, you know, on raising the pension and cutting more of the salaries and so on and so forth. But if no bad surprises happen, this is going to drop. But would this mean that this could very well go up? And if this goes up, this becomes the highest level since here, which is basically 609, which is June 09, which is basically the high, which is when the crisis started to abate. Okay, so you got the point. So basically, what I'm trying to say is that now I want to one last comment of this chart. Why am I spending so much time? Because the thing about technical analysis, or if you want to fundamentalize technical analysis, so you can stare at this chart a lot, but if you're going to try to put a fundamental or an economic spin to it, what are you going to say? You're going to say, when this thing came down, this spread, bad things happened, okay? But what you want to say is that here in 2010, what you need to know is that in 2010, when this happened, there was only Greece that was bailed out. But right now we're talking about Greece, we're talking about we've done Greece, we've done Ireland, we've done Portugal, and there is people are running left and right to try to find something for Italy. And we are only here. So this means that's probably going to be more stuff coming down. I'm going to look at the trading implications for the traders, euro dollar day to day as we go along, okay?